Welcome, everybody. I'll just go down the line here. Deirdre, I'll start with you. It's not terrible for Didi, but it's also not sort of wow amazing. What do you make of the trading action so far?
It's not great. And when you put it beside some of the other names that debuted today, that IPO pop is not as strong as some of the others, and it has eased off even in the last 20 minutes. Remember, too, that this IPO was priced conservatively at $14 a share. That gave it a market cap of about $67 billion. And even at nearly $80 billion now, that is less than what some had thought it might fetch in public markets, up to $100 billion as recently as just a few months ago. We know that public market investors have been a little cool on ride-sharing. Uber and Lyft have underperformed the broader market since they went public, and Didi is facing a lot of the same issues, namely unprofitability, as well as regulatory scrutiny, which is ramping up in China. So a lot of questions about this IPO. And even though it is the dominant player in China, it's not exactly a great place to be if you're a big tech company right now, the dominant player. So that is what the Chinese government is looking at right now, antitrust concerns. So this could quickly switch. And also, you know, its margin per ride sharing is profitable, but it makes a much smaller margin than, say, an Uber because it operates in China.
Mike, we just showed some of its biggest shareholders, which do include Uber. And if we check on Uber shares, they are red today. Now it's still over $50. So, you know, it's come back a little bit in the past several weeks. But it does suggest that, you know, the enthusiasm that everybody had about ride hailing is a distant memory. I mean, Uber went public in 2019 and is only up, maybe 10% from those levels. So Didi aside, what does the trading behavior of the rest of the group so far tell you?
Well, actually, what you're shooting for, ideally, in an underwritten IPO is something on the order of maybe a 15% first-day gain. It's not really written down that way, but rule of thumb is, you know, you don't necessarily want to max out demand. You also don't necessarily want a stock to double on the first day, because that usually causes those cries of, oh, they left money on the table, or it didn't seem like it really gauged demand properly. So I don't think that the way the stock is trading is necessarily a concern. Definitely undershooting some of the more optimistic valuation estimates out there. I'm not surprised about that, because ride hailing, it's no longer new. It's mostly about the questions about long-term profitability and less about, you know, how is this going to change our lives with robot fleets and everything else that they used to fly around.
And Maureen, we are going to be speaking with the CEO of Xometry a little bit later on. They're up 60% today. Some of these other names are doing very well that are actually some of the less familiar ones. It's interesting that, you know, some of the widely known names, Zoom is, again, LegalZoom, having a good day, but some of these smaller players even more so. Where is all of this enthusiasm for these shares coming from?
I think it's about the future. I mean, the growth potential, as Mike and Deirdre both said. I mean, ride hailing is an old industry in some ways now. I mean, there's only so much growth left. These companies now have, you know, investors are excited about companies. They're excited about future prospects. You might not know the names of them, but investors are seeing that they could go much higher. And we've seen that in some of these names. You know, maybe no one knew what Snowflake was last year before they went public. So I think there's this enthusiasm around the future and growth potential and how high some of these stocks could go.
Shepard Smith here. Thanks for watching CNBC on YouTube.